Hey, it's Similoli here, and in this video I'm going to go over 2 ways in which you can use moving averages to trade profitably. Before we get into the video, I'm going to ask for one thing in return, and that is, you got it, like the video, comment below, most importantly, don't forget to subscribe, and I will meet you in the video. So as you can see, we're starting here with a blank screen, no indicators, nothing, just price action. We now want to add our moving averages. So the first thing we're going to do is create them. So this platform is THINKORSWIM, and you can open a free account, and it's a very useful platform to trade, because they have a lot of features on it that really stand out and can help you perfect your trading strategy. First thing we're going to do is we are going to populate this section, added studies and strategies, and we're looking for the exponential moving average. So we'll type in expo, see what comes up. Moving average, this one. We want 3 of them, so we're going to add it, add it, add it. It's the same thing, same parameters which we want to change. We want to change the first one to a 3-day moving average, the second one to a 8-day moving average, and the third one to a 20-day moving average. We're going to click on the settings button here, and simply that goes down to 3, and green is the color I use to represent the 3-day moving average. 2, just this number just shows how thick you want that level to be. I choose this representation of the graph. It's cleaner and not as kind of busy as these other ones. And this one is the style. I just don't want it dotted or broken. I just want this continuous band. So that's basically the parameters that you need. So we'll click OK, and we've done the first one. We'll move on to the second one, which we want that one to be the 8-day moving average. The third one is going to be the 20-day. And that one I tend to make a kind of bright yellow. I like my colors to pop. Same parameters there. Okay. The only other thing we're going to put on this particular study is volume. I always want to know what's going on with volume. So we're going to highlight this volume. And the volume we're looking for, there it is, the volume average. Just want to highlight it, and then I want to add it, and it automatically populates the volume section. I'm going to apply it, I'm going to click OK, and voila. Okay, so this is the green line represents a moving average over the 3 days, the prior 3 days. The purple, the 8-day moving average, and my yellow represents the 20-day moving average. This represents volume within the time scale of the candle right above it, right there. And all this shows is when price action was moving from the bottom of this candle to the top of this candle, volume fell below the average 50-day volume. So it just shows you right here, volume has exceeded the 50-day moving average. So now this is done, we're going to pick up the chart I'd done earlier. Trade. So selecting Roku as a stock I want to use to show and demonstrate my moving averages, you can see the crossover going on here. Prior to this arrow, we didn't have these moving averages in the right order. We have the 20, then we had the 8, then we have the 3. We ideally want the lower moving average to be above at the top the next moving average, the 8-day, to be below it, and the 20-day to be below that. So they've crossed over at this point, and it makes where this white arrow is a perfect, close to perfect entry point. One quick note of caution is, even though this is a good entry point, it's important, highly important, that you always want to wait for a closure of that candlestick before you enter into your trade. If you're particularly risk averse, then you need to wait for 2 candles to close before you enter that trade. Then you'll wait until this candle finishes its movement, because even though it's a green candle, it could easily have ended up a red candle, and you wouldn't know which direction it plans to go until it completely closes, which means until that 1 minute is completely over. By the same token, if you're looking at the 5-minute candlestick, then you would need to wait for a completion of that 5-minute period before you enter into the trade. And as you can see, price action headed up over a 1, 2, 3, 4, 5, 6, 7, 8, over an 8-minute interval. So if you enter your trade at this point, after 8 minutes, you want to exit the trade because something's going on here, and my down arrow here shows the point at which you might want to exit the trade. Now again, what's going on? Let's look at the crossover. Now you can see that order 3, 8, 20 has changed at this point, and the 3-day has gone down below. This, if you're very risk averse, you want to exit at this point. But what I would usually do is I follow the direction of the 20-day. The 20-day is the stronger moving average. It shows a more definitive trend than the 8-day or than the 3-day. So I wouldn't exit that trade until I see 2 candles closing below the 20-day moving average. So even though the first 2 smaller moving averages have crossed, but they haven't altogether crossed below the 20-day, which is the stronger of the 3 moving averages. So I would stay in this trade, because with this candle, it closed below the 20-day, but by the second candle, remember I said you want to wait for 2 candle confirmations. Now, if the second candle had also closed below the 20-day moving average, then I would have been out of that trade. But look what happened. It closed above it. So that tells me that I still have a fighting chance to make this trade even more profitable. And as you can see, it keeps heading up. It stays above the 20-day, and the 3-day again decides to move up again right into position. So again, we have 3-day, 8-day, 20-day, which is what we want. Price action heads up. The 3-day looks like it wants to come back down again. It keeps going. It keeps going till it gets to this point, and it does it again. The 3-day crosses below the 8-day, but not below the 20-day. So we stay in this trade. Stay in the trade. It closes below all 3. Normally speaking, I'd be out of this trade, but look what happens the very next minute. A green candle. Another crossover. Let's see what's going on. We have a crossover here, but then we have them in the right position here. Green, purple, yellow. So this could be another entry point. This could be a point at which you want to add onto your position in this trade. And between this white arrow and, let's see, the high of the day, we have 1, 2, 3, 4, 5, 6, 7. We have 7 minutes to stay in the trade longer, making this an even more profitable trade than if we had exited, say, back here on this false breakdown. The points to note are the white candles show a point of entry because the moving averages are in the right order, with the smaller average being at the top and the larger one, the largest one, being at the bottom. Once that order is broken, you want to start considering getting out of the trade. But if the crossover of the two smaller averages is still above the 20-day, there's still a chance that that trade could go your way. But what happens here, the first two crossover and then everything collapses below the 20-day. Again, this would be a point to exit, or if you're more optimistic, a trader, as I can be sometimes, then you don't want to exit the trade after just one candle breaking down. You want to see and wait until the second candle. Then you wait until the second candle to exit the trade. A note of caution, this method works better on the larger time scales. As you can see with the 1 minute, it shows a lot more choppiness. So there's not a decisive move in one direction for a long enough period of time, and that's because I'm showing this on a smaller time interval. But if, say, this was on a 30-minute time interval, for instance, and this candlestick represents 30 minutes, this represents 30 minutes, then this movement or the observance of the moving averages would be more significant. Another feature of the moving averages is that you can use them as levels of support and levels of resistance. I tend to rely on the 20-day, being that it's the stronger level than the 3-day and the 8-day. I rely on the 20-day to determine whether I'm going into a trade or when I'm exiting a trade. So when action is above the 20-day, I'm more confident to enter the trade. And when price action falls below the 20-day, I want to begin to consider coming out of the trade. So 3 things you want to bear in mind with using these moving averages is that it can be used in 3 main ways. The first way is that it can show you the general trend of the market, if the market is trending up or if the market is trending down. The second way in which you can use it to actually show the levels of support and the levels of resistance. And the third way to use moving averages would be to help identify more precise entries and exits. Now, as a word of caution, moving averages are more effective on the higher time intervals. So we're talking the 4-hourly, the hourly, the 4-hourly, and the daily, etc. It stands to reason that there would be a greater chance of success if each candlestick represents a larger period of time rather than it just representing 1 minute. Just a little word of caution that moving averages tend to be more reliable on the higher time intervals than on the lower time intervals. And I think that generally is the case just across the board for most indicators, where your higher time intervals, your hourly, 4-hourly, daily, etc., will give you more reliable information because it spans across a longer period of time. So that's about it for this video. I hope you found some value in it. If you have, don't forget to drop that like. Drop me a comment, ask me your questions. I'll do my best to get back to you. And most importantly, don't forget to subscribe, and I'll see you in the next video.